Bring in Edward Jones, senior investment strategist Mona Mahajan, to talk about, Mona, where you see sort of August ending up and whether or not this so-called loss of momentum it could be longer lasting.
Yeah, I think Mike summed it up well when he said controlled pullback. That's what we're seeing thus far. And in fact, I think thus far we are down about 3 to 4% on the S&P 500 since the end of July. But the NASDAQ and that Magnificent Seven are down a bit more, 5 to 6%. When we look at valuations, it's interesting to note that NASDAQ Magnificent Seven still about 25, 27 times next year, but the rest, the 493, about 16 and a half times. So much more reasonable from a valuation perspective when we think about a broadening out from market participation. Now, what we would say is when we look historically, on average, when the S&P runs 15% plus, we do tend to get about an 8% pullback from there. Now, there's a range around that, and perhaps some of the higher flyers will correct more, and some of the rest, the rest of the market may not correct as much. But generally speaking, we would expect, after such a strong run, some period of consolidation, some profit taking, and we think some caution is probably prudent here as we're heading into, of course, August and September, which are notoriously volatile months. But that being said, as we think about the underpinnings, the fundamentals of the market, a lot of it is still intact. Markets have priced in better inflation trends, maybe a Fed that can ultimately step to the sidelines, and of course, an economy that is holding up much better than expected. And when we look to 2024, we would expect the earnings picture to reflect that. And over time, the Fed has even told us they'd like to gradually move back towards a more neutral level. So rate cuts may be on the horizon as well. So that's not a bad backdrop over the next 12 months, but we'd be a little bit more cautious in the near term.
Right. So what seems reasonable for 24? S&P earnings in the, 220, 230 range with a cut in the second quarter?
It does feel like earnings this year look like they're going to be flattish. We probably will start to see a bit of a rebound in Q4. But 2024, the estimates have ranged between, 7 to 12%. So we do think something more in line with historical average, 7 to 10% earnings rebound after a flattish year is reasonable. And if you are looking at parts of the market that can experience some valuation expansion, you do have better, there's an opportunity for a return profile there that looks fairly reasonable. In terms of rate cuts, harder to handicap here. What's, I think, more credible is that markets are now pushing out rate cuts till about May of next year, so mid next year rather than early next year. We think that's a good and more comfortable place to be, as the Fed is very reluctant to declare mission accomplished on inflation. I think they do want to see a 2 handle at least before they start thinking or signaling rate cuts. We do think, though, that the shelter component will start to filter in with a lag effect over the next 6 months or so. So core inflation should start to trend better here. The offset, of course, will be, does this strong economy create some sort of rebound, and the commodity market, of course, as well.
Right. And that could be an offset, too, as gas prices are back on the rise. So, Mona, bottom line, can tech rally with yields at these elevated levels and the economy continuing to perform well and data better than expected?
Yeah, we think tech in the near term may take a breather, but not to say the rest of the market can't pick up some of the slack. So we think one of the themes for 2024 certainly should be in your portfolios a broadening of market participation. Both, we think AI is still at the early phases of a long-term secular bull market, but fully valued here. If you get better opportunities, a good place still, but make sure you have the balance with not only small cap parts of the market, cyclical parts of the market, international could start to become more favorable then as well. And think about your bond portfolio. That opportunity to extend duration, we think still over the next 8 months could be really interesting here. You're locking in better yields, and you have that opportunity for price appreciation as well.